This is Peter Elides with you. We're going to be doing a selection for you today, talking about the Elides cycle price projection statistics. I was going to do this recording originally with Stefan because I wanted to introduce him to all of you. Several of you have spoken with him, perhaps, or written to him, but I wanted you to get an opportunity to meet him. But we had a few technical glitches, and we figured the best way to get it done would be simply to go over it from my perspective and then show it to Stefan and see if there was anything he wanted to add. So what we're going to look at is the statistics module of our projection program. And here is a disclaimer. I'd like all of you to read this. I know you're not going to read it quickly now, but just click on your video to pause and read this in terms of the disclaimer. The regulatory authorities would like to make sure that you read them too. And then this is the chart we're going to be examining. S&P 500 composite index, call it the cash index to distinguish it from the futures. The time period on the chart is 3 years, but we're only showing back to around mid-November of 2019. Okay. And down below is the average true range chart. Now, the only reason we have this here is because we base some of our statistics calculations on the average true range. By the way, take a look at this. It's truly remarkable. For 20 days, for almost a full month, February coming into the end of March, the true range on the S&P was only, see down the bottom of the box there, 179, 178, 179, was the true range of the day. Incredible. Okay. Let's do this. Let's first of all show you, when you first get your program or when you first start using statistics, how to make sure that they're available in your program. So you want to double click either one of the offset lines or the signal line, the light blue line, and that will bring up the parameters box, the customization of the indicators, okay? And once you do that, you come down to record statistics. Now, a lot of the times when you first get the program, this will be false, because you don't always want to see the statistics. You just want to see the projections. And so this, when you put the statistics on here, it just takes longer. Especially if you have a long period chart up there, this is going to take that much longer to calculate your statistics too. So unless you're really working with statistics, you can leave this on false. Otherwise, if you want to see the statistics, set this to true. And once you do that, now another thing that's happening, and this is a glitch I think that's more Windows and TradeStation related, is sometimes the box for statistics will not pop up right away. If that's the case, then you just go to show statistics again here, and there it is. It will either pop up, but there'll be another box, another icon down below on this taskbar. Notice there are two trade stations. The one on the right is the one for web chart and statistics. The one on the left is the program itself. So if your statistics box does not pop up right away, simply click on this and it should pop up. If two or three things pop up, like a web chart and statistics, just go to the furthest one to the right. That's the latest one that you've chosen. Okay, so now the statistics box is here. What are we looking at? Here's the symbol we're looking at. Here's the time zone that the data covers. Again, not necessarily what you see on the chart, but the complete amount of data that's been loaded, and the data the statistics are going to look at is shown right here. Just about 3 years of data, August of 17 to July of 2020, okay? The next line shows you what particular offsets you're examining at this time, and projection prices. This will almost always be high-low. I've said several times in the past, the only time I use closing price projections is with daily charts. There's a reason for that, and that is that if you work with, let's say, a mutual fund that has closing prices only, and you want to know when to enter or when to get out of a trade, if you're trading with, let's say, an index mutual fund, you can look at the closing prices and get those projections and work with those. Once you use closing prices, all the statistics will be based on closing prices. that would usually be high-low. Projection margin of error, this is almost always 0. The only time we put it at 10% is when you're using weekly charts that show very small offset differences. In fact, not at all. When we have a weekly chart and you want to do a 10-week offset, you simply do 10 and 10.01. And in that case, you'd want a projection margin of 10%. The Nick filter period is exactly what we've talked about with Nick filters. And we'll show you how that can affect projections, sometimes dramatically, and it affects the way that you use them, okay? So let's go down to the next section here and see what we're looking at. These give you the results. So now you know what the offset is. When you click Statistics, the results will pop up here. And the most important results of all are total confirmed projections. So this shows you the number of total projections that were confirmed, not just given on a preliminary basis by crossing one of the offsets, but by crossing above or below both the offsets. That happened 64 times. In 49 of the 64 times, that projection was reached. That's a pretty good percentage here, rounded off to 77% of the time. And down below that shows you the upside projections and the downsides. So you'll notice that 64 projections, there were 32 up and 32 down. The upsides were reached 72% of the time. That's pretty good. The downsides were reached 81% of the time. That's very, very good. Okay? So that's what the first few lines of our offset show here. What I'm going to show you now is how the Nick filter affects these things. And first of all, let me give you an explanation of why we use the Nick filter at all. Let's take a look at one of the projections here. Okay, here's an upside projection from this low in March 23rd. If this bar had come below both of the offset lines, but only for one bar, and then continued back up again, I wanted to make allowance for that in the program because that happens, not that often, but it happens often enough that you want to be able to eliminate this. You want to be able to say, okay, there was a nick for one bar below both of the bars, but it immediately went back above. And so I want to be able to ignore this and not show this as an invalidated projection. And the way you do that is by changing the nicks. And the way you do that is you double click on either the signal line itself, the light blue one, or one of the projection lines, and it brings up the nick filter. So if we change this to 1, it will ignore any of the nicks that are 1 bar long. In other words, if this case, if it actually went below here for a full bar, then that would be ignored, okay? How does that affect the projections? Well, let's take a look and see. We'll bring up the projection box. And now these are going to be new statistics, okay? It went from, I think it was 74, well, it went up to 77%, rounded off. And both 77 on the upside and downside. Let's go quickly to 3 nicks and see how that affects it. Let's go to 3 nicks because the nicks do affect the projections and they affect the statistics, okay? So now if we go to show statistics, wow, significant change in the percentage success here. 86% if we take 3 nicks into consideration. 83% of the upsides and 89%, almost 90% of downside projections were reached, 16 out of 18, if we consider a nick period of 3, okay? So that's what the nicks do, and that's how they can significantly improve your results. But let me also show you the other side of that, because sometimes there are unintended consequences. Let's go out on this and look at, sometimes it works in your favor. For example, right here, if there were a nick here and we waited for 3, 4, or even 5 bars, it was our nick period, that would be an advantage because we had a pullback here and we'd be buying at a lower level. But usually when you have a nick, it's going to work against you in terms of the best place to be if you're placing an order or working out your research for your statistics. Okay, so I wanted to show you how the nicks work and give you an idea as to the benefits of it and, in many cases, the detriments of them. Because if you have a nick filter of 3, then you really should wait 3 bars after your projection's given. Make sure there are no nicks. And if that's the case, then you know into that time period that your projection percentages go up significantly. Of course, you could get a nick after the first 3 periods, and should that occur, you would have to take that into consideration with your statistics also. So there are so many different ways that the nicks can affect the projections. Okay, so the next thing I want to show you is these functions here. Consider projection missed by a percent of the average true range, and that is reflected in this chart down here, okay? So let's first of all get rid of our nicks. And that's something very important to do, by the way. If you do use a nick filter period, be sure you move it back to 0, or you're going to start getting statistics that are not true statistics. They'll be only the statistics for a 3 nick, which will not apply to most of your other projections. You'll see how this whole picture changes with the projections given once I get rid of the nick, okay? So make sure you go back to 0. Bring up your statistics box once again. And again, let me talk about this glitch where we say to show the statistics, they'll pop up momentarily and go away. Just go down to this second trade station icon and they'll click on it. It'll bring up the stats again. Okay, so now these are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 bars here. Look up here. There were 15 invalidations of projections out of the 64 that were given. 49% were met, 15 were invalidated. Of the ones invalidated, by how much did they miss the projection? Okay? And each one of these shows you, okay, invalid projections missed by a percent of the ATR, the average true range. And so, as you look at this chart, there's a couple of other things I want to show you also. Notice as you hover over each bar, it'll give you 2 numbers. The first number is the number, which projection this was. This was the 29th, this was the 34th, this is the 41st, 46th. You say, well, what do those numbers mean? Well, if we go back up here and look at the next tab, it shows you all the projections given, the complete history of the data you have entered in the chart. And each one of these is numbered. So, let's go back to the results again and look down here. This was a big excursion here, and this was projection number 10, as you can see up at the top. 144% of ATR was missed by. You say, well, let me see where that is on the chart. So all you have to do is recognize it's the 10th projection given, go back to the projection window, look at projection number 10, click on that, and immediately it will take you to the far left of the screen where that projection was. See how this one was invalidated? You see how much it was missed by quite a bit here. Now what you can do then, if you can't see it, is quickly go to the chart itself and just scroll over a little bit so you can see the complete projection. It was based on this low, as you can see, based on this low and this crossing, and it was invalidated down here. How much did it miss by? Well, we show you with that bar how much the projection was missed by. That's an important statistic. Go back down here, bring up the statistics again, go to the results page and look at the charts. And this shows you in 2 different ways how much you missed the projection by. You can see it way over on the left here, how much it was missed by. Here's the highest bar after the projection was given. So this was the projection. And again, it's taken as a percentage of the average true range. So you would look at the average true range at that time period, and you'd see this is what this percentage represents, okay? 144.5%. That's a big miss, okay? And you can look at it two ways. Missed by percent of ATR or just plain points. How many points was it missed by? Well, it was missed by 53.5 points almost. These were missed by a lot, 67 points, 79 points, okay? This is a big one. Let's take a look at this one if you want to see it on the chart. It's number 80. So again, you go to projections. You go down to number 80 and say, okay, show me that on the chart. Projection number 80, June 19th. Now, in a case like this, it won't be way over on the left because it depends on the number of spaces you have to the right. In that case, you can look at it and find it by number 80 and look at start time right here, June 19th. So in that way, you just go to your chart here and scroll across and look for June 19th, okay? So that's right in this area. So now you know which projection you're talking about. So for the most part, it'll be on the far left of the screen, except when the screen can't move over that far because of the limited number of spaces to the right. That's how you identify them. That's how you do your research with those statistics, okay? Let's bring up the statistics again. Okay, here is a very important function. It's consider the projection missed by a percent of ATR as reached. And what that means is, let's actually bring you up the definitions of these so you can see them on our chart. So invalidated projections missed by percent of ATR. This shows you in picture form exactly what that's talking about. You consider a barely missed projection as being reached by varying the percentage of points the projection is missed by the average true range at the time of the invalidation. Actually, we're going to change this a little bit because we're going to change it to the average true range at the time the projection is first confirmed. So, look at the picture here. Projection was confirmed on this bar right here, okay? And then we came down, we came up, and we invalidated it right here by going back above both of the offsets. So what happened in here is important for us for the statistics. The projection was given here. The first time we could act on a closing basis was, I should say the projection was confirmed here, was the close of the bar this day, which is right up here. The average true range at the time of the invalidation and the percentage of points it's missed by subtracting one from the other. So the upper projection here was 290290. That's the only one that's important. We want to know how much it missed by coming into the box. Well, the top of the box is at 290290. The lowest point reached was 292375, okay? And then it came up and then it invalidated. So this is how close it came. And that's the percentage the projection was missed by, and by the average true range down in this area here. So you want to know, based on what the average range is of the S&P each day, how much did we miss the projection by? It came out to 20.85 points, and the average true range at that time, 76.19. So you divide the 2085 by 76.19, average true range, and you come up with you missed it by 27.4%, okay? Now, again, down here, we note that the look-back period of the average true range can be defined at the study input statistics for the ATR period. You can change that in our statistics box in the inputs. Okay, when you change the statistics from false to true that you want to see the statistics, just below that on the input box, it asks what look back you want to use. 20 periods. You want to use the last 20 periods, and of course that would be a trailing 20 periods. No matter where you look on the chart, it would show you the past 20 periods, the average true range. Okay, so that's how you determine how much the projection is missed by, and that's what is shown on this chart here that we're going to go back to. Let's go back to that chart now and take a quick look at it. Bring up the statistics module. Okay, this is what you see here. You measured by how much you missed the projection by after you saw an invalidation given, and you can use that statistically to help you out in the program. Watch what happens. Consider the projection missed by what percent of the ATR. Right now it's set at 0. That's the default. As I go up, okay, watch this chart, which shows how much they missed by. By the way, you can do both percentage of ATR missed by or raw points. Click right up here, either one of these. We like to look at the percent of ATR, and then look at the top right here. As you click to different percents, notice the black horizontal line. Now there's a couple of things to point out here. A lot of the times, the projection will be missed by a very small margin consistently. Let's say 20%, 10% of ATR. And if that's the case, then you can take advantage of that in your trading by using that. For example, if you look at this and look at the percentage reached, watch how this changes. It will not change dramatically because most of these are pretty large percentages missed by. So if I go to 10%, this statistic goes from 76.6 only up, well, actually stays the same for 10%. For 20%, it goes up a little bit. And you can see that right here. You see, that only affects one of these invalidated projections, okay? This one would be considered as met because it missed by a little bit here. If we go up to 30, 40, 50%, it does not change it much. You're not normally going to go much higher than 50%. I mean, you can go virtually as high as you want. You can wipe out all of these projections here and say that they were all made, but by the time you show that, then there's no benefit to you at all. Okay. Let's go down to the next statistic. Oh, by the way, this shows you the average right here of the projections that were missed. By how much were they missed? And it says 76.2% of the average true range for the period. If you go to points, it'll show you the average number of points the projection was missed by, okay? These are pretty high for this 7 to 8 offset, and so you probably wouldn't be able to take too much advantage by changing this average true range. As I said earlier, some of these will be smaller, and you'll be able to take good advantage of and reach a very high level of percentage met by changing this just by a little bit. But the higher these bars are, the less a chance you have of affecting your projections by a small change in the percentage of average true range that those projections were missed by. Okay, let's look at the next box. Before we go into showing you a little more detail of this, let's go back to our definitions here. Okay, maximum adverse excursions. What in the world does that mean? That simply measures from the close of the confirmed projection bar to the highest or lowest move in the opposite direction, depending on whether it's an upside or a downside projection, before the projection is reached. Okay, so follow here. Here's the signal line. The blue line goes to the midpoint of each bar. Right here, the projection's given. So now you want to know, theoretically, the first time you can act is at the close that day. That's $25.97.50 is the price. Now, this is an upside projection. So to get from here to here, do we want to buy immediately and risk what happens in the meantime? Because if you do buy immediately, this projection remains in effect until met or invalidated. So theoretically, if you're going to use the system that way, and I don't necessarily recommend you use it that way, you buy at the close and say, okay, I'm just going to hold it until you meet it. Well, it's nice to know, based on past history, based on statistics and facts, what generally happens with this offset of 7 to 8 after a projection is given. And this tells you exactly what happens. Here's the projection, the closing bar, the confirming day. Here's the projection given. And what happens? What's the worst that happens after the close that day? Well, you can see visually. This is the worst that happens. 24, 14, 25. That is the maximum adverse excursion or reaction to the downside for an upside projection. Obviously, for a downside projection, it would be the exact opposite. You want to know how much does that move against you to the upside. But that's what our next group of statistics shows you. In this case, it's 25.9750 minus the 24.14 1/4. This distance right here equals 183.25. You divide that by the closing price where you could have bought, and that shows 7% was the maximum adverse excursion. Okay? Let's go back to the statistics page. All right, so now there are a lot of ways you can use this, and we're not going to recommend any of the ways. We just want you to be able to have the research. And so the research shows you the average adverse reaction. You can use it in two ways. You can use it if you want, if you do enough research. And again, don't just use it because I'm making a suggestion. Do your own research on your own, whatever you're using for an analysis, whether it be the S&P or the Dow or a particular commodity or an individual stock. Do the research on that particular entity before you try anything. But this tells you that there's an average adverse reaction of 0.7% from whatever price the projection is given. So there are two things you can do with it. You can say, okay, let me cheat. Let me not buy when the projection's given. Let me try to buy a pullback if it's an upside projection, or a rally if it's a downside projection. And if the average pullback is 0.7% from when the signal's given to when the projection's met, maybe take half of that and say, okay, I'll buy it at 3.5 or 3. These are not percent; these are 0.1%. So you say I'm buying a pullback of 3 to 0.4%. Okay, that's one way of using it. Another way of using the average maximum adverse excursion is as a stop. So if this is the maximum adverse excursion, you can see that 0.7%. You might want to use that or a little bit more than that as a stop in your position. You could also look at the individual adverse reactions and see perhaps you might want to take the largest one out and go to the next couple of ones that show 1.8%, 1.7%, 1.8%, pretty consistent. And so that would be another potential place to place your stop in a trade. I think we basically covered almost everything. Notice up here at the top right that if you click on that as you're looking at statistics, it will take you to our website and take you to the documentation page that talks about these statistics. Okay? Takes you immediately there instead of having to go back to your browser and put in stock market cycles or whatever. It takes you there and we discuss statistics, show the definitions we showed you, show you the different pages, the different results, how to customize indicators, all the things you might want to see in relation to the statistics, okay? Bring up the stats again. This is important. Again, this is a glitch that's either a TradeStation or Windows related, because Stefan has arranged it. When you click on statistics, it will come up, and sometimes it disappears. If it does that, just go back down to this second TradeStation icon, click on it, it'll bring it up. So we've discussed, I think, almost everything here. This horizontal line shows you what the average is, as does this horizontal line show you what the average is. And that's basically how to use the statistics page. I'm sure some of you will still have questions. Remember, you can look at both upside and downsides, and if you're working on an upside projection, probably be more statistically significant if you look for the statistics for upside projections, okay? But all three of these stats are important: upside, downside, and total number of projections reached, okay? And just very quickly at the end of this whole thing, let's go to one more offset just to show you how these statistics change. Look at 72%, look at 81%. Remember those numbers generally, and let's quickly go to change our offsets here. Let's go to the next longer one, 12.1 and 13.8. And go to the statistics box from there, show statistics. Look at that, this time the box stayed up. Look at how it changes. Not anywhere nearly as good, 66% total, 68 for upside, 63 for downsides. But this is important that I showed you this, because now watch how you can change using this box, how that start to change significantly once you get up to 60%. Okay, that brings it up almost to 80% reached. 50% of ATR brings you up to 75. But I wanted to show you the interrelationship of how all of these things change when you change your offsets, when you change your NIC filters, when you change your projection margins, when you change either close or high lows. These are all interrelated, and you just have a huge box full of statistical probabilities you can look at that should help you enormously in your trading. We hope you take advantage of it, and we hope you comment to us and tell us, first of all, that you appreciate Stefan's work in all this research. Some other people have given suggestions, some of them very good, some of them not quite so good, not so realistic. But we welcome suggestions on your part in terms of what you'd like to see. Remember, we have a lot of things that we have in mind to do for you and for the programs. One of the things is to bring the whole program onto our website, okay, so you can access it all there. So there are a lot of things on our menus right now, on our totem pole of priorities. So, but whatever you would think you would like to see, let us know. We'll do the best we can to improve our program in any way we can. Thanks for watching. I hope I've answered a lot of your questions, given you a lot of knowledge. And again, you can send us comments in terms of what you'd like to see in addition to what we have already. Thanks for watching.